Hi, my name's Steve Clapham. I'm the founder behind The Balance Sheet, and I'd like to welcome you to the latest in our series of accounting red flag videos. And we're going to talk today, detection tool number 8, circular transactions. What do I mean by a circular transaction? I mean a transaction that a company does effectively with itself. And often, in the case of frauds, what companies do is they'll take a capital item and turn it into income. So they'll convert something that's really a capital raising and convert it into a flow of income so that it can exaggerate its earnings. Before I get into it, just like to remind you, please sign up on our website behindthebalancesheet.com and you'll get access to our free newsletter and a whole load of free training materials in our club site. They're really, really good. And if you're serious about investing and you want to invest some money in your own skills, I'd recommend looking at our investing courses. But let's look at Greensill. And one of the reasons that we were attracted to Greensill and wanted to look at it was we'd learned that Vodafone was both invested in the Greensill Supply Chain Finance Fund and was using that fund to prepay invoices. Now, Vodafone's got negative working capital, as you can see in the slide. The black line in that chart is below the zero line, so it's got negative working capital. And the reason that Vodafone was doing this was to depress the amount of capital employed in the business, to make its returns on capital look better, and to make the cash position look better. But it made no sense that it was getting the cash earlier, right, because it didn't need to pay its suppliers as quickly, and it was using that money to invest in the Greensill fund. Mathematically, this couldn't be a way that Vodafone could earn money from doing this because the fees were too large. So it just didn't make any sense that Vodafone was doing this. And this is exactly the sort of thing that you want to look out for. A company that's engaged in transactions which don't appear to have a real commercial rationale. And usually when you see that, you know that there's something wrong. Here's another example in the case of Greensill. SoftBank. SoftBank was invested in the Vision Fund. SoftBank was invested in Greensill, and Credit Suisse, through the fund, was lending to SoftBank investees. This circularity of transactions, again, doesn't make sense, because if SoftBank wanted to lend money to its investees, it would be cheaper to do it directly without involving the Credit Suisse fund because of the fees. So with the Vision Fund invested in Greensill, Greensill was not a tech company. Greensill used third-party software. They invested over $1 billion and lent some additional money. So SoftBank will have lost well over $1.5 billion. And SoftBank was also invested in the Supply Chain Finance Fund, which invested in several investees. This sort of circularity, can you see the money's going into the fund and then ending up with the investees, it'd be better for SoftBank to invest direct or lend them money directly. So when you see this, you have to ask yourself, well, why are they doing that? And it's always the case, if you see a circular transaction, there's usually something odd about it, and you usually ought to be suspicious. Not that SoftBank was doing this necessarily to deceive, I'm not suggesting that, but it was a very unusual transaction. And I think what the end impact was that the SoftBank investees looked more attractive than they otherwise would. So I hope you've enjoyed it. Don't forget, sign up on behindthebalancesheet.com to get our free newsletter and access to our free training materials. Thanks for watching.